We know investing is the reliable path to generational wealth, yet a massive percentage of consumers keep their money entirely out of the public markets. They look at a single corporate stock and see a fragile entity that could shatter overnight, taking their hard-earned capital down with it. This anxiety is completely rational. Deploying your highly limited liquid runway into one isolated balance sheet on Wall Street means you carry all the exposure. If that specific company dissolves, your entire investment dissolves with it. Deploying isolated capital into one asset means total loss if it fails. Instead, pool your capital with others into a centralized treasury. This multiplied purchasing power buys fractional shares of every asset simultaneously. If one fails, the surrounding assets effortlessly absorb the shock. And that unyielding logic of fractional ownership is the exact structural architecture powering the entire global investment fund matrix today. Financial media constantly throws a wall of aggressive institutional jargon at you. They talk about mutual funds, index funds, exchange-traded funds, and elite hedge funds as if they require multiple finance degrees to decode. Despite their different regulatory labels, every single one of these vehicles runs on the exact same pooled asset engine we just broke down. They all collect cash from multiple investors to buy a wide basket of assets. Mastering this system doesn't require complex mathematics. It only requires understanding how each vehicle executes trades, and crucially, how heavily it extracts fees from your principal. The first major pillar is the traditional mutual fund. This is a massive capital pool governed by an active portfolio manager who aggressively buys and sells assets every day, attempting to outsmart the broader market. That active human tracking is incredibly expensive. These funds extract an annual expense ratio, structurally siphoning anywhere from 0.5 to 1.5% of your total invested capital every single year. You pay this fee regardless of whether the fund actually makes you money. Traditional mutual funds also carry heavy operational friction. They do not trade in real time. You can only execute a buy or sell order after the daily closing bell rings, settling at a strict end-of-day price. On the far end of the active spectrum is the elite hedge fund. It relies on the identical capital pooling logic, but it legally walls itself off from retail consumers, catering strictly to ultra-high net worth individuals and massive institutions. Because they operate entirely unconstrained by consumer protection laws, hedge fund directors deploy massive debt and aggressive short-selling campaigns. In exchange for this high-wire execution, they enforce a brutal fee structure, a flat 2% management fee, plus 20% of all your net profits. Both traditional mutual funds and hedge funds demand intense, unyielding fees. They justify this drain on your capital by promising that their human-engineered strategies will heavily outperform the market. But there is a hyper-efficient alternative. The index fund introduces absolute passive management. It completely fires the human stock picker, replacing the entire Wall Street team with a blind, highly efficient algorithm. This algorithm perfectly tracks a predetermined market list, like the S&P 500. It automatically purchases fractional equity across all 500 listed corporations. If a company drops out, the system cleanly ejects it and instantly buys the newly ascending replacement. When you wrap this passive strategy inside an exchange-traded fund, or ETF, you unlock a massive technological advantage. The ETF entirely bypasses the restrictive closing bell rules of traditional mutual funds. These funds are instantly executed on public exchanges during active market hours. You trade them exactly like an individual stock from your phone, with nearly all modern brokers enforcing zero minimum entry thresholds. By combining flawless algorithmic tracking with real-time exchange liquidity, index ETFs give you highly efficient, virtually frictionless access to the entire global economy for a fraction of the traditional cost. So if we look at a multi-decade timeline, who actually builds more wealth? The hyper-expensive Wall Street manager aggressively pulling the levers, or the cheap, blind, passive algorithm running on autopilot? When you run the historical data across the United States markets, the math is undeniable. Over a long-term investment horizon, passively managed index funds and ETFs systematically outperform the vast majority of highly paid active mutual funds and elite hedge funds. Why does the algorithm win? First, the market is incredibly efficient. A human manager might predict the right moves for a few consecutive years, But mathematically, maintaining a winning streak across a full 30-year macroeconomic cycle is nearly impossible for a single human being. And second is fee drag. This chart shows two compounding portfolios racing upward over a 30-year timeline. One is an actively managed fund carrying a standard 1.5% management fee. The other is a passive ETF running a near-zero fee of 0.03%. Watch what happens as that seemingly harmless 1.5% fee compounds against you. Over a 30-year horizon, a massive gap forms. That tiny annual extraction will quietly confiscate up to 1/3 of your total potential retirement wealth. The global investment matrix is incredibly powerful, but it is entirely a numbers game. To achieve absolute financial sovereignty, you have to aggressively minimize fee drag and step permanently away from single asset risk. By deploying your capital into heavily diversified, low-cost index ETFs, you stop paying Wall Street to guess the future, and you start actually owning it.